It's a mixed bag of economic data coming out of China. Growth still on target, but property prices in the doldrums and factory activity falling for the third month in a row. The big question for me will be the pace of China's economic recovery and what factors will impact that growth the most. Mr. Heng Kun Hao, Head of Market Strategy at UOB, thank you for talking to me today.
Thank you.
When you look at the key indicators for China's economy, what have you got your focus on?
We look at two indicators. Now, on the manufacturing side, clearly the PMI numbers are very important. Across the state-owned enterprises, the smaller enterprises, these numbers need to recover more above 50. They are now struggling around the 50 level, right? Then the other set of indicators we look at very closely revolves around consumer sentiment, right? Retail sales number, sales of EV cars, so on and so forth. We would hope to see a little bit more recovery, much more widening in terms of consumer expenditure in China.
What about the risks and the pressures that are facing China's economy going forward for this year?
The Chinese economy is going through a transitional period, right? Property prices, residential property prices are still declining. So if your asset value is declining, you don't feel confident about the future and you tend to save more. So the silver lining amidst all this is that we all know the Chinese economy, Chinese are strong savers. So there's a pool of savings that's waiting to be deployed, but how do you make people confident enough to spend more? I guess that's that missing link.
What stimulus measures are you expecting from Beijing this year, Mr. Heng? Do we think that the PBOC may even cut interest rates further?
The People's Bank of China will continue its targeted interest rate cuts. So we do expect loan prime rates, whether it's in the 1 year or the 5-year tenor, to be cut by 10 basis points in this quarter. Now, the big uncertainty is what levers, what the Chinese authorities can do to help rejuvenate the property sector. They need to further reinvigorate spending and confidence and basically loosen buying restrictions, so on and so forth, to basically restore demand. Now, on the balance sheet part, how do they help the property developers refinance their indebted balance sheet? How do you restructure the balance sheet so that you allow the property developers to build again, to contribute to growth to the economy?
In order for China's economy to continue to grow in a robust way, it needs to be able to look for perhaps more markets, more sort of different sectors. What stands out to you?
So China is absolutely still investable, no doubt about that. Now, there are near-term uncertainties, of course, but over the long run, we cannot ignore China's size. We cannot ignore the significance of the spending power coming out from China. Now, here's the trick. Over the long run, we need to identify new engines of growth for China. The old engines of growth are over, like the property sector, for example. We need to identify new megatrends to look forward to. Clearly, this will be in, for example, the silver economy, in sustainability, and the new technologies.
Thank you very much, Mr. Heng.
Thank you, Dawn.
It's been a shaky start to Chinese markets so far this year. After a dismal 2023, are Chinese equities set for a comeback? Market experts in Hong Kong tell us their views.
Take a step back and look at what happened in 2023. And if I take the MSCI China benchmark as a point of reference, it fell by about 13%. There was worries about the economy, worries about geopolitics. At the same time, fund flows were reasonably negative. If we see the earnings recover and the economy recover, certainly I think you'll see two things happen. Number one is a re-rating of the market. And number two, obviously the earnings itself would be sufficient to drive the market returns. We're starting to see some green shoots that point to stabilization, but certainly we do need a little bit more evidence, but I think it's definitely on the right track at this point.
Yeah, it's a tough one regarding sentiment and the question about what is going to be the catalyst to see a market rally. There is probably no one single catalyst. It's really about investors having this reset of expectations, seeing continued policy support, even though it's incremental, we do need to see that to try and see a pickup in sentiment, especially relating to the property sector, because this has a knock-on effect in terms of consumer sentiment and people just basically wanting to spend. We could all say that the Chinese market is incredibly attractive when we look at the multiples. So trading, below 10 times when we look at forward price earnings. But it's more than that. We need to have attractive valuations combined with the earnings coming through, and really that sentiment domestically picking up again. And that would then have a knock-on effect in terms of how foreigners view the Chinese market as well as the Chinese economy. Gone are the days where you're going to have, or you have one single sector or group of companies underpinning the market with stellar returns. It's going to be much more diversified. And again, we can't underestimate the growing importance of the domestic investor. And along with this importance of the industry itself, the financial service industry, the pension reforms that we're seeing coming through, you're going to see investors in China looking at total returns. So not just potential capital appreciation, but also looking at that income stream. So, the prospect of a higher dividend payout ratio and better dividend yields is certainly likely to come through over the long term.